Welcome to 3 and 3. Today we're going to be talking about the internet versus the potential AI bubble, the lost decade, and the broader market. So the internet versus the potential AI bubble. So the current speculative environment increasingly resembles the 1999 to 2000 tech bubble. The leadership is very narrow, which means there's only a small amount of stocks that are actually leading the market higher. There's this new technology, of course, artificial intelligence, and investors are disregarding diversification, and they're increasingly adding exposure through risk, which is, again, in a very narrow market, which means that these stocks start to actually go down, that could lead the overall market down at a faster pace. The relative performance between the NASDAQ 100 and the Russell 2000, which of course includes more stocks, is as extreme as it was during the tech bubble. As you can see from this actual chart, you can see the relative return of the NASDAQ 100 versus the Russell 2000 and the extreme actual valuation difference between the two indices. The lost decade. So lost decade refers to the period between 12/31/1999 and 12/31/2009, when the S&P 500 delivered a negative total return of negative 0.9% annually. The 1999 to 2009 period was marked by the collapse of the late 2000s tech bubble, the 9/11 terrorist attacks, Iraq and Afghanistan wars, and the 2000 to 2009 great financial crisis. And you can see from this chart going back to 1999 that the Vanguard 500 index, which represents, again, those 500 companies, basically went up, back down through the actual 2001-2002 correction, hit a peak again right around 2007, and then corrected during the actual 2008-2009 financial crisis, and then broke even by the end of the year. The broader market. So the U.S. stock market has been top heavy with few large companies, primarily in the tech, driving returns for actually the last several years. Diving deep into the 1999-2009, we can see that there were opportunities by broadening investment exposure. Now may be an especially good time to diversify away from the concentrated indices and enter the broader market. And you can see during that time period, the S&P 500 had a negative return of 0.9%, where the S&P 500 equal weighted, which we equally weighted the stocks in the actual S&P, had a return of 5.1%. The mid-cap index was 6.3, and the small-cap index was 6.4. Thank you for joining us for 3 and 3.